Henry Campherdam, a self-made man, a multimillionaire, and now, much to his regret, somewhat of an expert on tax shelters. In 1999, Campherdam was running his own computer company in Indianapolis and paying himself a salary of $200,000 a year. Life was good and about to get much better. A competitor came forward and bought his company.
And your cut was $50 million.
Well, some part of $50 million, that's for sure.
And he barely had time to count his money before he got a call from his longtime financial advisor, Ernst & Young, the third largest accounting firm in the country.
Ernst & Young came to us, and in fact, they were involved with helping us sell the business, so they intimately knew what was going on. They came to us and said, look, instead of paying all these taxes, why don't we do a tax shelter that, in essence, will eliminate all of your taxes? And when someone says that to you, especially when they're a trusted advisor, you're going to listen.
At a sales pitch at their Indianapolis office, Ernst & Young told Campherdam that the tax shelter was so creative it would cost him $1 million in fees, and so secret he couldn't keep any of the literature and would have to sign a non-disclosure agreement.
Ernst & Young felt very protective of the design of this shelter, and they had a great deal of concern that someone would get this design and steal it from them.
Did you understand this tax shelter and how it was going to work?
No, did not.
And quite honestly, after a half a dozen interviews, neither did we, except that Ernst & Young called this particular tax shelter Cobra. We sought out Lee Shepard, who makes her living explaining tax law for a publication called Tax Notes.
The tax law is complex, and people who are tax professionals like to have clients believe they're magicians. It's very flattering.
And that it's very, very complicated.
Oh, it's so complicated you couldn't possibly understand it. Your head would explode if we had to explain it to you.
It turns out she was right, and we don't expect you to follow all of this.
Okay, here's Henry Campherdam, right here.
It began with Ernst & Young arranging for Henry Campherdam to buy two offsetting foreign currency options. One $50 million option bet the euro would go up. The other was a $50 million bet that the euro would go down.
So essentially what he did, he made two offsetting bets. There was no way he could lose any money on this.
Oh, no, there was no way. Yes, because one of the things when you are selling something like this, you don't want to be sitting there saying, but sir, you could lose $50 million on this. They're not going to want to buy if you say that.
Ernst & Young then began moving these two offsetting currency options through a series of hard-to-trace shell companies and partnerships, a complicated process Lee Shepard calls basis bouncing. By using a hypertechnical reading of the tax code, Ernst & Young decided that only one of the currency options had to be put on the balance sheet. Thus, it created a corporation with an artificial $50 million tax loss. That offset the $50 million profit that Campherdam made selling his business. Thus, he owed no taxes. Got it?
This doesn't look that simple to me.
This is a simplified version.
How did the accountants justify a $50 million loss on the currency transaction when, in fact, there really wasn't a loss?
Ernst & Young, who are experts on the tax law, felt that there was a loophole in the tax law, and through a very complicated, expensive accounting of this transaction, you could avoid the taxes and shelter the gain on it. And as I sit here 3 years from today, the discussion you and I would have on it would be very short because I don't fully understand it.
You understood from them it was legal.
Absolutely, and that's what you use those people for. If they tell us not to do something, we don't do it. If they tell us to do something, we do it.
Ernst & Young said all of the currency trades and financial transactions would be handled by the German financial giant Deutsche Bank. That would cost Campherdam another $3 million in fees. He would also have to pay for legal advice.
They had opinion letters from two major law firms in the country supporting this and saying that this tax shelter was good and it would pass an audit. So with Ernst & Young on top of the two law firms saying that we should do this, we did it.
The principal legal opinion Ernst & Young provided to Henry Campherdam and other people who bought the Cobra tax shelter was written by Jenkins and Gilchrist, one of the largest law firms in the country, and according to court documents, one of the designers of the tax shelter. That stack of papers cost Campherdam another $2 million. But Joseph Bankman, a professor at Stanford University Law School and an expert on tax shelters, believes Jenkins and Gilchrist's legal opinion was self-serving.
You can't make $2 million a pop and be independent in any meaningful way. I would think they were quite interested in how many people bought that shelter.
And between 75 and 100 wealthy people did. Bankman says the legal opinion may have made buyers like Henry Campherdam feel better, but in the end, it was little more than a sales tool.
And the sad fact is it doesn't mean anything.
Well, it amounted to something. He paid him $2 million for.
It certainly improved the salability of it from Ernst & Young's perspective. But when you get in court, the case is what it is. And if you're trying to take a $40 million loss on a break-even investment with no business purpose, you're almost always going to lose. And that's just what courts have said for a half-century now.
And that's exactly what the IRS decided about Cobra. It was trying to exploit an ambiguity in the tax code while clearly violating the spirit of the law.
The new shelters are just paper transactions. Nothing's created. There's no real investment. There's no risk. There's no possibility of upside or downside.
It's all paperwork.
It's all paperwork.
Sort of a shell game.
That's exactly right.
I mean, it sounds like a fraud.
That's right. And I think 20 years ago, that's what all the reputable firms thought.
So how did they get into the business?
Well, a few kind of mavericks without these moral scruples went into the business, and they did really well, and their clients didn't get caught. And then competitive pressures pushed more and more firms and taxpayers into this arena, till finally everybody lost their moral bearing, or at least most people did. It became the new norm.
Bankman says it really changed in the early 1990s when accounting firms began charging clients a percentage of the money they saved them in taxes instead of billing them at an hourly rate.
Do you think what they're doing is illegal?
Well, if it's not illegal, it's pretty close. It's certainly somewhat unethical, I think.
Besides Ernst & Young, the biggest names in accounting, law, and investment banking have all been caught promoting abusive tax shelters. KPMG, Price Waterhouse, Merrill Lynch, Bankers Trust, and the now-defunct Arthur Andersen, among many others. Internal promotional documents from one major accounting firm, BDO Seidman, showed just how cynical the tax shelter business has become. In a presentation for people in the tax department who called themselves the Wolf Pack, the firm's partners urged them to focus on one thing: money. All of us in the firm need to focus on money. Think green. Green is good. There's nothing wrong with trying to make more money. Where is the real money? Show me the money. It's right in front of our faces. Our clients have the money, and we have the services they will pay for.
These people, to the unsophisticated taxpayer, would be like a snake oil salesman 100 years ago.
Iowa Senator Charles Grassley is chairman of the Senate Finance Committee. After last year's corporate scandals, he vowed to hunt down tax cheats everywhere, and he's put the promoters of what he calls tax shelter scams at the top of his list.
The source of the problem are the accounting firms and the law firms that peddle these schemes.
How do big, reputable accounting firms get away with selling what you called a scam?
The legitimacy of it comes from the good name of the accounting firm that markets it.
The accountants and lawyers who devise these tax shelters would say that their legitimacy comes from the ambiguity of the tax code itself, and all they're doing is following the letter of the law, as written by Congress.
You just can't write tax laws precisely enough to avoid the ingenuity of lawyers and accountants to find ways around it. You just can't do that.
Could you explain one of these tax shelters to me?
I wouldn't attempt to even explain the tax code to you, let alone one of these shelters. I think.
And you're chairman of the committee.
I'm chairman of the committee. I even pay to get my own income taxes done. But when it comes to these schemes, remember, I'm not sure that they're meant to be understandable.
What people like Henry Campherdam do understand is the bottom line. Ernst & Young told him he would save $13 million in taxes, but he would end up paying $7 million in fees.
So instead of giving the money to the government, you were giving it to Ernst & Young, Jenkins & Gilchrist, and Deutsche Bank.
Yes.
Did you ever have a sense of uneasiness or pangs of guilt or anything about not giving this money to the government, about not paying full taxes on it?
I've paid taxes for 35 years. And if I have the opportunity to save taxes as a result of some very strong advice, I had absolutely no guilt about doing it.
But now the IRS is going after him for the $13 million in taxes it says he owes, plus interest, plus penalties. Turns out Ernst & Young, responding to a demand by the IRS, turned his name over to the federal government, along with the names of all the other people who bought the Cobra tax shelter. They're all being audited one by one.
They've talked like we're the cheats, we're the ones who defrauded the government, we're the ones who maliciously went out and tried to steal tax money from them. What I don't understand is why they have not gone after Ernst & Young and Jenkins & Gilchrist and Deutsche Bank, who designed, marketed, and led us into this transaction.
That's just not the way the law works.
Until recently, B. John Williams was the IRS chief counsel and top enforcer. He says his agency's powers are limited when it comes to going after people who actually devise tax shelters.
The money that would have gone to the government is going to the law firms and going to the accounting firms and going to the investment banking houses. Why not go after them? They're the ones that got the money.
Well, the law provides that we have to collect from the taxpayer who owes the money. And if that taxpayer has a beef with the professional advisor, taxpayer can sue him and let the court sort it out.
It seems to me that you could make a case that if you wanted to deter this sort of behavior, the people you go after ought to be the people that are devising these tax shelters and promoting them.
Well, we have gone after them within the bounds of the law.
But the bounds of the law are fairly narrow. The IRS did go after Ernst & Young this summer, fining them $15 million for failing to register certain tax shelters. Professor Bankman says
the penalties are an infinitesimal piece of the pie right now. So if you compare the gross amount of billions of taxes lost to the penalties levied, it's 1,000 to 1 or something.
It's not even a slap on the wrist.
No.
Henry Campherdam hopes to administer a swift kick to the groin. He's suing Ernst & Young, Jenkins & Gilchrist, and Deutsche Bank for $1 billion, alleging they knowingly lured customers into an illegitimate tax sham.
We didn't expect Ernst & Young to take our money and go walking down the street, never to hear from them again.
So they just they walked away from you.
I would say they ran away from us.
If they'd never knocked on your door with this idea, you would have paid the capital gains taxes.
We had our pen over the checks, ready to go.